Ladies and gentlemen, the banking landscape is on the cusp of a huge systemic shift, and there is going to be much more pain coming ahead. Because did you know the US banking system actually is the most decentralized, and there actually is more banks in the US than anywhere throughout the rest of the world? But the Federal Reserve, the US Treasury Secretary Janet Yellen, they don't like this at all because it makes it much harder to control. And so what they're planning is they're planning on much more mergers that will be coming, and we're going to see the 5 big US banks become even bigger. We could get even to a point where they are the last one standing. And you may think, well, what's a big deal with that? Well, the big deal is you won't have anywhere to run or hide. If you say anything wrong on social media, bang, your bank account will be frozen and you have nowhere else to go. They can implement social credit scores and universal basic income with a lot of strings attached. So everyone, this is a major shift that is going to be coming. So we're going to go into this report on how it's going to happen and then how we can prepare. Let's get into it. Well, look at this, everyone. The American banking landscape is on the cusp of a systemic shift and expect more pain to come. So again, everyone, what exactly is this shift that they're talking about and how painful is it going to be? Well, the whirlwind weekend in late April that saw the country's biggest bank takeover, its most troubled regional lender, marked the end of one wave of problems and the start of another. After emerging with a winning bid for First Republic, a lender to rich coastal families that had $229 billion in assets, JP Morgan Chase CEO Jamie Dimon delivered the soothing words craved by investors after weeks of stomach-churning volatility. This part of the crisis is over. While we're going to challenge Jamie Dimon's view on this and go over why it's not over. But even as the dust settles from a string of government seizures of failed mid-sized banks, the forces that sparked the regional banking crisis in March are still at play. So what exactly are these forces that are still at play? Well, rising interest rates have deepened losses on securities held by banks and motivate savers to pull cash from accounts, squeezing the main way these companies make money. That's exactly right, everyone. We're seeing hundreds of billions of dollars in deposits being taken out of the largest US banks and they're flowing into money market funds or other alternative assets. Losses on commercial real estate and other loans have just begun to register for banks, further shrinking their bottom line. Regulators will turn their sights on mid-sized institutions after the collapse of Silicon Valley Bank exposed supervisory lapses. So that's exactly right, everyone. We're seeing the office commercial real estate market get absolutely hammered. It is absolutely collapsing, and this could cause another financial crisis for the banks that are most exposed. So what is coming will likely be the most significant shift in the American banking landscape since the 2008 financial crisis. Many of the country's 4,672 lenders will be forced into the arms of stronger banks over the next few years, either by market forces or regulators, according to a dozen executive advisors and investment bankers who spoke with CNBC. So this is them warning you, everyone. They always tell you what's going to happen before it happens. We're going to see thousands of banks collapse or merge with these bigger banks, making these bigger banks even bigger and creating an even bigger monopoly on the banking system. You're going to have a massive wave of mergers and acquisitions among smaller banks because they need to get bigger. The co-president of the top 6 US bank, who declined to be identified, speaking candidly about industry consolidation. We're the only country in the world that has this many banks. And also the US is home to a lot of freedoms that many other countries don't have, and a constitution they desperately need to hold on to before it's taken away. Because look at this chart here, everyone. Big banks are outperforming the regional banks in 2023. So the Dow Jones US Bank Index is the dark blue line, and the light blue line is the KBW Nasdaq Regional Banking Index. And we can see here the big banks are only down 10%, while the KBW Regional Banking Index is down 24%. So the sudden collapse of SVB in March showed how quickly banks could unravel, dispelling one of the core assumptions of the industry, the so-called stickiness of deposits. Low interest rates and bond purchase programs that defined the post-2008 years flooded banks with cheap sources of funding and lulled depositors into leaving cash pocketed accounts that paid negligible rates. So that's exactly right, everyone. Over the past 15 years since 2008, interest rates have been dropped pretty much to zero. Banks have been flooded with cash. They haven't had to pay any interest because people really had nowhere else to put their money to earn yield. But now that people can get yield on bonds and in money market funds, they're pulling their cash hard and fast. So this is leading banks to come under severe stress. So after 10 straight rate hikes and with banks making headline news again this year, depositors have moved funds into search of high yields or greater perceived safety. Now it's the too big to fail banks with their implicit government backstop that are seen as the safer places to park money. Big bank stocks have outperformed regionals. JP Morgan shares are up 6.6% this year, with, like we said, the KBW Regional Banking Index is down more than 20%. But there's a new shift happening in the banking system that's making bank runs a lot easier, quicker, and more damaging. So that illustrates one of the lessons of March turmoil. Online tools have made moving money easier, and social media platforms have led to coordinated fears over lenders. Deposits that in the past were considered sticky or unlikely to move has suddenly become slippery. The industry's funding is more expensive as a result, especially for smaller banks with higher percentage of uninsured deposits. But even the mega banks have been forced to pay high interest rates to retain deposits. So this is another great chart here, everyone. We can see that bank deposits hit a peak in April of 18.2 trillion. Then we saw a bank run of about $1 trillion from April to May. But this is how a lot of smaller banks are going to go under or taken over by bigger banks. So compounding the industry's dilemma is the expectation that regulators will tighten oversight of the banks, particularly those in the 100 billion to 250 billion asset range, which is where the First Republic and SVB were slotted. They warn there's going to be a lot more costs coming down the pipe that's going to depress returns and pressure earnings, said Chris Wolf, a Fitch banking analyst who previously worked at the Federal Reserve Bank of New York. The higher fixed costs require greater scale whether you're in steel manufacturing or banking, he said. The incentives for banks to get bigger have just gone up materially. And listen to this. This is massive, everyone. Half of the country's banks will likely be swallowed by competitors in the next decade. And look at this next chart here, everyone. The US has more commercial banks than all other G7 countries combined. So we can see here the US has 4,800, the UK has over 300, Germany 250, France 228, Italy 218, Japan 112, and Canada only 81. So while SVB and First Republic saw the greatest exodus of deposits in March, other banks were wounded in the chaotic period, according to a top investment banker who advises financial institutions. Most banks saw a drop in their first quarter deposits below 10%, but those that lost more than that may be troubled, the bankers said. If you happen to be one of those banks that lost 10 to 20% of deposits, you've got problems. And this is another banker who declined to be identified because he'd be sacked in an instant. He warned you either have to go raise capital and bleed your balance sheet, or you've got to sell yourself to alleviate the pressure. A third option is to simply wait until the bonds that are underwater eventually mature and roll off the bank's balance sheets, or until falling interest rates ease the losses. But there's a big issue with that. That could take years to play out, and it exposes banks to risk that something else goes wrong, such as rising defaults on office loans that I think is definitely going to happen. That could put some banks in a precarious position of not having enough capital. So everyone, what this is leading to is a false calm. A lot of people think the banking crisis is over, but we may find out very, very soon with more regional banks posting their earnings that more deposits are gone than we first thought. So a fair number of them are looking at their balance sheet and trying to figure out, what do I have that I can sell and get an attractive price for? Banks are in a bind, however, because the market isn't open for fresh sales of lenders' stock despite their depressed valuation. Investors are staying away because of further rate increases could cause another leg down for the sector. And he also warned that the last few weeks have been a false calm that could be shattered when banks post their second quarter results. The industry still faces risks that negative feedback loop of falling stock prices and deposit runs could return. And this is all that needs to happen. All you need is one or two banks to say deposits are down another 20%, and all of a sudden you'll be back to a similar scenario, pounding on equity prices, which then feeds into deposit flight, which then feeds back on equity prices. This is called a doom loop. And so which of the big four banks could be the next to face some big issues? While investors are very, very worried about Bank of America, they're down the most out of the big four banks. We can see here JP Morgan Chase, they're up 7.3%. We can see Wells Fargo up 3.6% and Citi 1.1%. But again, Bank of America down 13%. So that tells me investors are very, very worried. So everyone, I know we're thinking, well, okay, what does all this mean in simple terms, and how can we protect ourselves against a banking crisis? What this simply means is the pain for the banks aren't over, and we won't know how bad it really is until this next earnings season is over, when we figure out how much of their deposits have been taken. And the next big catalyst for the banks, like I've been warning about, is commercial real estate. This is going to cause huge losses on these assets, just like what caused the first banking crisis, losses on bonds. Well, the next big crisis will be losses on commercial real estate, or CMBS, commercial mortgage-backed securities. So okay, how can you protect yourself? Well, first, don't have more than $250,000 in one bank. You want to diversify your money across multiple banks, or even better, hold some of your money, hold some of your cash in real money. That's gold and silver. Gold and silver has been money for thousands and thousands of years. They've always created fiat currencies and they've always failed. And next, what you can do is actually hold Bitcoin. A lot of people would think this is very, very risky. Well, the fractional banking system is very, very risky as well. But with Bitcoin, what we saw during the banking crisis is it actually appreciated in value, because what you can do in Bitcoin is you can actually self-custody it. You can have your own private key memorized or stored in a vault that absolutely nobody else can access but you. So everyone, this is very, very worrying. The Federal Reserve and the US Treasury, they want more mergers to happen. They only want a few banks in the US to make it more controllable, but we need to have more options to take our money so we can protect ourselves and go to banks who will actually not close our accounts for having the wrong political opinion. Now everyone, if you're wanting to learn how to build wealth and master the cycles of gold, silver, and Bitcoin, protect yourself against the next financial crisis that will be coming, and also make massive, massive returns, or you can click the link in the description below for my course that's on sale right now. And once the course is finished, it will be doubling. Now, everyone, what do you think about all of this? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.